Thanks for joining us today on Market Call. I'm Morella Fernandez. Bruce Campbell on the show with us today, President and Portfolio Manager at StoneCastle Investment Management. He'll take your questions on Canadian stocks. Here's how to reach us, 1-855-326-6266. You can also send your questions by email, marketcall@bnnbloomberg.ca. Bruce, good to see you.
Yeah, thanks for having me on.
Let's start with the markets, which have been bouncing back from the start of the Iran conflict fairly quickly. Why do you think that is?
I mean, there's history that always repeats, and then there's rhymes, and then there's human behavior that always repeats. And I think that's exactly what we saw happen here, is that the investors were concerned about the conflict and what that meant, and then they start to shrug that off and then look at what individual companies have been doing, and the earnings have been, so far that have been released, have been very strong, and as a result, the confidence just comes right back into the market.
Okay, for the NASDAQ more specifically, what have you noticed?
Yeah, I mean, what we've seen there is that's been where a lot of the strength has been from this recovery. Technology is really leading the way. And then if we look at what we've seen is we've actually seen a breadth thrust, which is, looking at advanced declines over a 10-day period where it goes from a low to a high. And when that's happened in the past, it's been very strong for returns going out over the next year in that sector.
How are you positioning yourself at this time?
Yeah, I mean, we're positioned, fairly broadly. So technology is one of our largest exposures, and then we have some industrials, energy, and then and a few other special situations that kind of round out the portfolio.
Okay, are you watching for certain signals, certain indications in case you need to pivot?
We are, yeah. I mean, we run a top-down process where we talk about being on offense in neutral or defense, and we have certain indicators that we like to watch with those, and they had actually pivoted and had us going into neutral back in March, and then we moved back on to offense in April. We watch those quite closely, and when they change, we adjust our asset allocation, meaning that we bring down our equity exposure and bring up our cash exposure in the portfolio.
Okay, can you give me more of an idea of what you're exposed to at this point?
Yeah, like as far as sectors or
yes, sectors.
Yeah, I mean, like I said, we have our largest exposure is in technology right now, and then that will be followed by industrials, which is a fairly broad category for us, and then energy after that.
Okay, what are you doing with financial? What are you doing with metals?
Yeah, I mean, with our metals, we actually brought that down a fair bit. We've seen, we run a combined rank where we look at just under 3,000 companies in North America. And what we saw was that if you go back to January, that was dominated by metals names. And then as we've seen earnings increasing in other areas and accelerating at a faster rate, we've seen the metals names falling back in our ranks. And so as a result, we've cut that back. So for instance, with our precious metals exposure, if you go back to January, we were sitting probably around 17 or 18%. And right now we're around 7% in our portfolio.
All right, let's take a quick break then, Bruce. We will be back with the first phone calls for Bruce Campbell of StoneCastle Investment Management. Again, taking your questions on Canadian stocks today. Back in a moment. Welcome back to Market Call. We're going to start with an email today for Bruce from Franny. She says, I'd like to ask Bruce about Anaergia, ANRG on the TSX. He's spoken about the stock on previous episodes. I would like to know if he still likes the stock and what his 6 to 12 month outlook is. Anaergia, I think, went up to something like $3, just above that. What is your outlook for the stock?
Yeah, we continue to hold it. It was a past pick on Market Call, and we continue to hold it in our portfolio. We're really excited about this company and really what the prospects are. If you remember back when I talked about it as a top pick, what we saw is that we saw a recapitalization of this company and new management come in, and they really have turned things around. So they went from where they were owning a lot of the facilities to now where they're just simply building those facilities or providing some maintenance contracts for those services. And they still own a few facilities, but they are gaining some massive traction if you look at what they have announced as far as contracts and backlog. And I think that this trend continues. They're going to have a tailwind behind them for multiple years as we move towards more green and more biogas and efficiencies from using waste to drive production facilities, plants, and then also to move that renewable natural gas back into to the energy pipeline itself.
Let's move to the first caller then. Mike's on the line. He's in Toronto. Mike, go ahead.
Hi, I'd like to ask about Happy Belly Food Group. I bought a small position on one of your recommendations. I'm down a bit. It seems to be holding pretty well, though, above the 150 level. Do you think this would be a good place to add a little more?
Thank you for the question. Remind us about Happy Belly, please, Bruce.
Yeah, so they're in the quick service restaurant business, and this is, again, another one of those turnaround stories. So Sean Black and his team came in a few years ago now, and at the time they got some fairly significant option awards if they hit certain thresholds with the stock and also with the business, and they've really just gone ahead and executed on those plans in a massive way. So what they've done is they've rebuilt the portfolio. So the brands that they have that you would kind of know about, Rosie's Burgers is one of them, Yolks is another, and now what they're doing is they're just going out and targeting locations, coming up with franchise owners, and then they're just in the process of building that out. If I understand correctly, they want to be at about 100 restaurants this year, and I think in their pipeline now it's around 600. That's going to take a few years to get up to that place. If you look at what the incentive program was laid out, is $2 was one of the major milestones, and they hit that. And when they got to that level, they then set in higher levels, so sort of $3 all the way up to $10 with the stock, and they get incentivized based on what happens with that stock, and so they're working to get that up and going. If you remember, it was also a past pick of mine on Market Call. And it moved up quite dramatically after that point in time. It's pulled back here and consolidated. And one of the big knocks that I've heard when I've been reached out by other institutions have reached out to us to get our opinion on it has really been the valuation. And so this is a function of it really having to grow into that valuation. You have to understand what the management team is doing and that they're executing and that they'll get to those numbers because they're quite aggressive. And then as a result of that, the multiple is fairly high. If I didn't own it right now, this would probably be a good entry point because it looks like it's gone through this consolidation phase and is set for the next phase of uptrend.
So you'd be happy with them picking up some more?
Yes, exactly, yeah.
Okay, let's go to Kat on the line then in North Bay, Ontario. Kat, go ahead.
Hi, thanks for taking my call. I'd just like your opinion on Neo Performance, please.
Thank you for the question, Kat. So they use rare earths, rare metals for applications. Is it a company you know well?
It is, yeah. I mean, we've talked about it on the past in Market Call, and we do hold it in our portfolio. It does tend to be a little bit more volatile. It can chop around a little bit kind of on news and based on the size of it. But, we think that rare earths area continues to be one that has fairly significant focus because of, geopolitical events and geopolitical tensions between countries that hold a lot of rare earths, for instance, China. And then the fact that there's not that much not many facilities around the world that can process the same way that Neo Performance can. And so we think that, over time, it's just going to continue to gain more market share as they're considered to be, more in the safer jurisdiction and have that technology that they can to refine those different rare earths.
Okay, that was Neo Performance for Kat. Let's go to Dennis on the line. He's in Cochrane, Ontario. Dennis, go ahead.
Thanks for taking my call. I'm calling about Whitecap. I own a strong position, and I love the income that it's generating. And they report tomorrow, our aftermarket. Where do you see this one going? And especially, they're making money at $60. So imagine now at 105. Thank you very much.
Thank you for the question. Whitecap Resources here. So up 92% over the last year and to $15.94 on the day. Of course, there's a lot going on in the energy space right now. So what's your outlook for Whitecap?
Yeah, we don't own it, but I mean, it's doing extremely well. It's hitting new highs here, and as Dennis mentioned, great dividend that's paying out nice capital. The thing that we've seen from a lot of the energy companies in Canada specifically is that they've been very focused on capital and returning capital to shareholders. So they're doing that by way of dividend and also doing that by way of share buyback. And Whitecap's been particularly strong in this area. If you look at the numbers, they have very strong cash flows now. And what they're going to report probably doesn't have too much built into what they're going to be getting. But if you just look at what's happened with energy, those prices just go right down to their bottom line because their costs will have increased a little bit, but not that much. And so the next few quarters should be even stronger. And of course, if we have energy hold up, maybe not even in this range, but even in the kind of $80 or $70 a barrel range, it's going to still be great things for their cash flow. So we don't own it right now. We have other energy companies that we own, but it is one that's ranks very high on our combined rank.
Let's take a quick break then, Bruce. We'll be back with more phone calls and emails from Bruce Campbell, StoneCastle Investment Management. Again, I'll take your questions today on Canadian stocks. Here's how to reach us. Back in a moment. Welcome back to Market Call, and thanks for joining us today. I think we have Frank on the line in Huntsville, Ontario. Frank, go ahead.
Hi. My question is about TD Bank and Royal Bank. I'm kind of confused about these stocks because recently they've made new highs, and I don't understand what's propelling them to make new highs given the economic situation in the housing market, whatever. So I would like to know what's causing them to make new highs. And please don't tell me there's more buyers than sellers. I'd like to know the why.
Okay.
And also, I'd like to know if there's any foreign buyers that are maybe influencing the cost of these bank stocks. Okay.
Okay. Thank you for the question, Frank. Do you see what is causing financials to gain at this time?
Well, I think it's more foreign buyers than sellers. No, that's a bad joke. I think what's happened is when you talk about knowing about this huge mortgage renewal that's happening, I think that's built in and that's like past information. And now what we're starting to see is that the front end of that, we are seeing those mortgage renewals happen, and there isn't a huge default increase, and consumers are able to continue to manage that credit, and they are able to take those higher payments. And so that's worked in, and that's started to see an increase in the share price. If you also look at the fact that, Canada is very resource dominant, and we're seeing, we saw this huge rally in the precious metals and base metals. And so there's a lot of activity and work that's being done there, which helps the bank's earnings. And now you're seeing the energy sector as well start to move up. And foreign investors tend to think of Canada as resources. With resources being so strong, if they're looking for opportunities, then they're looking specifically at the banks. They're solid, they're big, they're well capitalized, and they get to take advantage of that trend. TD in particular, it seems like a lot of the money laundering activity that they had to deal with from a compliance standpoint is now starting to move behind them, and that's been sort of left behind by investors, and so they are moving to new highs here. I think that that could continue if the commodity trend stays where it's at. That being said, I mean, the banks have had this huge move, so don't be surprised that when they report their next set of quarters, if the expectations just meet what they report, the stocks might just be flat or neutral for a little bit until we see that next uptrend in earnings.
That was for Frank in Huntsville. Hope we got his answer there. Let's go to Elliot in Hamilton, Ontario. Elliot, go ahead.
Good afternoon. Polaris Renewable, ticker PIF, has been stuck endlessly in the $12 to $13 range. Is that because of dislike for renewables, or maybe it's the geographic location they operate? Do you see any catalysts in the dividend yield? I believe it's a dividend play. Thank you.
Thank you for the question. It is at a 6.4% dividend, roughly. What do you think about Polaris? Do you see something moving this stock?
I mean, I think the two catalysts that are there for Polaris, one is that's kind of keeping it in range bound. One is that dividend yield, and as you mentioned, it tends to trade around that dividend yield. And the second is that one of their major assets is in Nicaragua, and I think that there's a view, rightly or wrongly, that there's some political potential risk to that. The stock also doesn't trade a lot of volume. It tends to be fairly well held. And so from an institutional perspective, it seems like if there's a big institutional getting into it, it pushes it up. And if they're getting out, it tends to push it down. The catalysts that I would look for there are if you kind of go back in history of what they did, when they recapitalized this business several years ago now, they started off with this geothermal facility that they have in Nicaragua. And then what they've done is they've been increasing other assets and building out other assets. So as they start to build out other assets in other geographic regions, that'll start to diversify and it'll take the stock higher. From my perspective, I don't, you never know when those catalysts are going to happen. They could happen, tomorrow or 2 years from now. So you have to be kind of comfortable holding the dividend and collecting that coupon while you wait for those catalysts to happen. It's not one that we own right now. We used to own it years ago when we had an income fund. We held it in the income fund specifically for that dividend.
Are there specific challenges operating in Nicaragua?
It's certainly challenging. It's not like if you were, operating in North America, there's going to be difficulties with regulations, governments, and then just labor and, and trying to make sure that, there's no issues that way. But from what I understand, it's been a few years since I spoke to the company. At the time, though, they had no issues operating in Nicaragua. It was a very well-run organization that they were dealing with. And it was a fairly intricate and important power facility for the government, and so they helped them and really allowed it to operate without a lot of red tape.
That was for Elliot. Let's go to Mike in Toronto with a question. Mike, go ahead.
C21 Investments, I'm very happy owning it because it's so, at least it almost makes a profit. But with the new rescheduling of marijuana in the U.S., I want to know what the effect might be, at least on the medical cannabis side. In other words, what kind of percentage medical cannabis does C21 actually do? Love your thoughts and opinions. Thanks a lot. Bye-bye.
Thank you for the question. Can you do a bit of a dive into C21?
Sure thing, yeah. So if you go back in history, when cannabis was all the rage, this was one of the companies that one of the few companies that really operated with profit. And if you look at what happened, is C21 itself bought an operator that was in Nevada, and don't think about Las Vegas, think about more the rest of the state and Reno and specifically. And they bought an operator that was excellent. He was stepping out of the business, but he's since stepped back into the business and continues to operate very well. The challenge has been the regulatory environment in the U.S. It looks like we're going to start to see some changes there. At sort of first blush, when the headlines hit the news that it was being rescheduled, the cannabis stocks all had a huge ramp up. But when you sort of dug a little deeper into it, it wasn't going to have the impact that a lot of investors felt it would, because these companies have already started to take accounting measures for that 280E, which is the taxes that they have to pay based on not being able to write off their expenses. And so they had already kind of taken those steps. Where I see C21 is it's an excellent operator. And I think at some point in time when cannabis gets more of a tailwind, someone comes in and probably just picks up the entire company for the operations and for the assets that are there. We don't own it right now. We've owned it. We owned it in the past and did quite well with it.
Let's move on then to an email. Bruce, this is from Fred. He says, please ask Mr. Campbell about the prospects for Tantalus Systems as a Canadian investment into the modernization of the North American electrical grid. So they do sort of solutions for public power and utilities. Do you see them gaining from the modernization efforts?
I do. And I mean, that's the big theme there, right? Is that the power grid is so old and isn't very efficient. And so their technology is helping the power companies to really make it efficient without replacing the entire grid. If you look at what Tantalus has been doing, they have multiple trials out, and I can't even remember the number now. I think it's in the sort of 60 different utilities that are trialing their gateway product. And what that means is that, those utilities typically will trial it for a certain period of time. And then after they've done that trial, then they start to sign contracts. So you just have to get through all that trial process. And then it could be, several big contracts happening all at once. And so I would think that, probably over the next 4 or 5 years, this company has a lot of prospects. And in reality, it probably doesn't last. It probably gets bought out once you start to see those utilities coming on and taking their product as their contract gets set in place. You'll eventually see a bigger player come in and just buy them out.
On that note, let's take a quick break. We're going to come back and have a look at Bruce's past picks. That's coming up next. Time now to go through some past picks from Bruce Campbell from July 9th of 2025. Kraken Robotics was your first choice back then. P&G on the TSX at $3.41, now to $7.71, so up 126%, and total return of 126%. I was talking to the CEO, I think it was last week, Bruce, and he was talking about how much business or queries are getting because of what's going on in the Strait of Hormuz. And of course, they do detection for underwater mines. It's just one of the things that is fueling this company.
It sure is. I mean, they have multiple different things happening all at once. And, if you look at the geopolitical tensions happening, that obviously accelerates things. But the whole defense contracting area underwater is going to be huge in the next few years. We've been, kind of above ground this whole time, and now a lot of different countries and different organizations are looking at under the sea and what that means. And I mean, looking at these unmanned vehicles for under the sea seems to make a lot of sense. It's a dangerous operating environment, and to be able to do so autonomously would be great. And I mean, they have multiple different opportunities, just as the CEO mentioned, because of inbound inquiries, but also because of new contracts, both from the defense and from the civil side. That'll mean that they continue to grow over the years. The stock does tend to be fairly lumpy, where you see big returns and then it consolidates, and then big returns, and the big one knock on it right now is valuation, but it's really growing into that valuation this whole time. Yeah, it is moving a little bit sideways, for the past couple of months. Let's get to your next past pick then. Zedcor, ZDC on the TSX at $4.29 at the time, which was last July, to $6.10 today, so 42% upside, 42% total return. And I remember you talking about this company, which has an innovative way of doing security. Basically, they have positioned high cameras. What's their expansion look like? I mean, they're expanding quite aggressively right now, especially in the U.S. So there's kind of two prongs to that. One is obviously having the customers, but obviously the second thing is having the towers. And so they've been quite aggressive with their builds in the U.S. So they're going to probably come in this year somewhere over 2,000 towers that are available. And they're starting to build an inventory so that if a bigger client comes in and says, hey, we need 100 towers deployed right now across our company and across our system, can you do that? They have the inventory to be able to do that. They have one of the largest home builders in the U.S. as a client, and they're now doing demos with a number of different retailers where they put these cameras out in the parking lot to deter theft happening. And so I suspect that as they start to see those trials come through successfully, they'll see continued add-on business to what they're doing. Do they benefit from AI at all? I was just going to say that, yeah, they've really been working on their technology suite to enhance the monitoring, and part of that will be AI technology, I would imagine. And what that allows them to do, of course, is charge higher rates for the same level or higher level of security that they have in the past, which is, just falls right to the bottom line. Let's get to your third pick then. MDA Space on the TSX, a favorite for a lot of Canadian sort of tech space investors. $39.12 at the time, $41.28 today. 6% upside for total return at the same. This company I know has an incredible backlog, and there's a lot of interest here, but the stock doesn't really seem to take off. Are you still holding it? Well, it's not that it hasn't taken off. It's had, quite a bit of twists and turns as far as their news goes. Yes, we still own it. But if you look at what's happened is they had, a few instances of some fairly bad news that came out that wasn't really it wasn't really a result of what they did. It was just they had a company that they were doing work for that got bought up. The most recent news, though, with Amazon buying out Global Star should really help them. But in addition to that, they'll have tailwinds behind them for years to come. I know you've had the CEO on BNN a few times, and one of the things he talks about, and when I've talked to him in the past, is just how the price of getting into space is coming down. And by that happening, it's really increasing the availability to a number of different applications. And that means more satellites, more equipment in space, and MDA is going to be providing that and supplying that. So it's one that, does tend to be fairly lumpy, but it looks like it has tailwinds behind it probably for the next 5 to 10 years.
On that note, let's take a quick break. We're going to be back with more of your phone calls and your emails in just a moment. Stay tuned. Welcome back. Kevin's on the line in Toronto with a question today for Bruce. Kevin, go ahead.
Thanks for taking my call, Marella. Bruce, I'm looking at Pet Value. It has come off its recent highs there a couple of months ago. I'm just wondering if I should get in now or wait for their report in May. Thank you.
Thank you for the question. How's Pet Value doing generally, Bruce?
The stock hasn't been doing very well recently. If you go back to, COVID, the stock was, was really strong. And since then, what we've seen is that not most, I shouldn't say that, but we've seen a lot of their clients really trying to go down value in what they're providing. And so it means that their business hasn't been as strong. Their margins have been a little bit lower, and they're really not seeing that revenue increase. And it had a fairly significant multiple before. And so that's certainly hurt the stock. What we really need to see is that, those earnings turn around, and then we see the trend of them gaining back customers who have sort of gone other places or have gone to lower margin products that they have there. But I mean, we all seems like we all picked up pets during COVID, and so certainly the opportunity is there. It's just how they can execute and how they can take market share.
Let's go to Ken next in Winnipeg. Then he's got a question. Ken, go ahead.
My question is Corby Spirits and Wines. It's a Canadian company, but its parent company, actually, I just found out its parent company, Pernod Ricard, just failed to cut a deal with Brown-Forman to buy Brown-Forman. Their stock is down, but the alcohol industry in Canada, all the companies are growing because of most Canadian provinces have cut off American alcohol. I want to know if this is a good investment. Right now I own 11% of my portfolio is in it. I want to know if I should continue buying because I like the dividend, or if it should get out. Anyways, if I could have your advice, that would be great. Thank you
for the question. Corby Wine, it's a smaller cap. I think it's $415 million in market cap here.
It is. It's a smaller cap, and it's also a fairly thin trader as well, because over 50% of the company is owned by that partner of theirs that they distribute for, and so as a result, it doesn't trade a whole lot. The dividend's been fairly good, and I mean, the management team, it was I'm just trying to think, it was several months ago that I met with the management team, and at that point in time they were just talking about the turnaround that they were making in the overall business and sort of their focus on profitability and increasing market share, and that's been happening, and you can see the stock's been sort of slowly moving its way higher. It doesn't hurt, of course, that we're seeing this. We're seeing this buyer strike from a lot of the provinces as far as U.S. alcohol goes, which with their Canadian produced product is certainly helping. But I don't know a ton about it. It's been a while since I did an update, but we don't own it right now. And I mean, I probably wouldn't be increasing my position bigger than what you have right now, unless you really felt strongly about it, just because that tends to be a fairly good sized position in a portfolio.
Would you exit part of that position?
It all depends on, what the portfolio makeup is and, what your objectives are. So it's hard for me to say. We don't like to have positions over around 8% of a portfolio. And in reality, even when we're getting to 6, we tend to get a little bit nervous. But that also is the objective that we manage based on, not not a personal circumstance that somebody else is managing for it. Perhaps he needs it for the income or something like that.
Let's move on then to our next caller, Bob in Toronto. Bob, go ahead.
Yeah, thank you, Marella, for taking my call. Bruce, I'm wondering if you could give me your thoughts on Element Financial, EFN. It's sort of lingering between 30 and 35. I think it has a high of 40. And I know a lot of pundits like this. They like this company, but I'm wondering what your thoughts are. Thanks a lot.
Thank you for the question. Is that Element Fleet we're thinking of, Bruce?
Yeah, sorry.
It is, yeah.
Okay.
Yes.
Yeah, it's Element Fleet, yeah. So, I think that the company certainly has tailwind, for a number of years. The probably part of the challenge has been that just in the last little while, there's been, the multiple got a little bit extended on it. But where the tailwinds come in is that, really what they have been doing is they're going out to customers that have their own fleets and then saying, hey, look, we can bring this in-house and manage it for you. And there's profitability for them, and it helps save costs for the company. It's, one of those things that doesn't happen overnight. They tend to be large contracts that happen, on a longer sales cycle. The company itself, continues to innovate and do interesting things from a revenue and increasing their revenue standpoint, in that they're getting a bigger market share from all of those customers as they add in, more benefits to what they're doing. We don't own it right now. It's one that we have owned in the past, but it dropped down in our rank a little bit based on just profitability and their earnings or lack of earnings acceleration. And so we don't own it right now.
Let's take a quick break, then we'll come back with more phone calls and emails for Bruce Campbell, StoneCastle Investment Management. Stay tuned for that. Welcome back to Market Call. Terry's on the line. He's in Nanaimo, BC. Terry, go ahead. Terry, are you there? Okay, we may have lost Terry. Let's see if we can go to Jim in Peace River. Jim, go ahead.
I'm wondering about Cenovus, please. Last year when Cenovus acquired MEG, I did a cartwheel. The price of oil so high nowadays, I'm hoping they're going to pay down debt. Where do you see them over the next 3 to 5 years, please? Thank you.
Thank you for the question. Do you have an outlook for Cenovus?
I mean, they're the 800-pound gorilla in Canada, right? So with the higher energy prices, it should really start to trickle down to their bottom line for sure. Their cash flow should increase. And, I would expect that, as all of these companies have done, they've been really efficient with their capital, and they'll start to pay down that debt that they have. And then, the one of the things is with that MEG acquisition, it was great for Cenovus. Probably not. I mean, I guess it was great in the short term for MEG shareholders, but I think a lot of MEG shareholders would have loved to have seen MEG stick around. But that's a great asset that they have as well, and it's it moves them in a different direction, and one that has a lot of security in North America because of that heavier oil that they provide, and the fact that there's only certain places that can supply the refineries with that, and the MEG assets are certainly one of those. We don't own it right now. We're a little bit more down cap with the energy in our portfolio, so it's one that we do have a lot of respect for, but we don't own it right now.
That was for Jim. Let's move to Keith in Paris, Ontario. Keith, go ahead.
Hi, Bruce. I was wondering if I could get your long-term opinion on Pesarama. I believe they're at 37 stores now with a goal to get to 500 stores. Where do you see the stock in 3 to 5 years? Do you think it could replicate Dollarama? And long-term, does it get taken out? And lastly, do you own this company? Thank you. I'll hang up and listen.
Thank you for the question. Does Dollarama own Pesarama, or is this a competitor?
I didn't understand it to be owned by Dollarama. I thought it was a competitor. It's a lookalike, but I could be wrong on that fact. Perhaps Dollarama does own some of it. We've looked at this. We looked at it back when it was a private, and then we've looked at it, on multiple different financing rounds that they do. It's certainly interesting. It's really they're really targeting to be one of Mexico's first dollar stores, and we know the success of these dollar stores. If it's the dollar stores or even the say Five Below that they have in the U.S., that is really something where the consumer goes to. You haven't really seen that in Mexico to date. And so this will be an opportunity for them to really grow that out and build that. It's a little bit of a newer theme, so it'll take them some time. But I suspect that, over time, this trend has been really in every consumer market around the world. It's not in Mexico. So they're the ones that are now doing it in Mexico. And I suspect that they're going to be successful as long as they don't, they do it in a measured way. And could it be taken out? I would suspect that it probably does at some point in time when they get to the certain level that a competitor, whether that's a Canadian or a U.S. Competitor, looks at them and says, hey, this is a good way for us to enter into that market.
Let's go to John then, who could be our last caller here. We might run out of time. John's in Toronto. Go ahead, John. John, are you there? Okay, we may have run out of time, so let's leave the block where we are. We're going to take a break. Back with some new picks from Bruce when we return. Join us tomorrow on Market Call. Brianne Gardner joining us on the show. She is Senior Wealth Manager at Velocity Investment Partners, Raymond James. She'll take your questions on Canadian and U.S. large caps. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Let's get to some new top picks from Bruce Campbell. We're going to start with Condor Energies, CDR on the TSX. This is an energy company that is in Canada, operates out of Calgary, but they have investments, I guess, in Kazakhstan and Uzbekistan. Can you tell me a bit about those investments?
I sure can, yeah. So this came to me by the same analyst who really brought our attention to TNAS back when TNAS was $2. So he really knows his stuff and really has brought our focus to this one. So if you look at what they have for assets, right now they operate in Uzbekistan, and they have around 14,000 BOE per day, and they think that with horizontal drilling and some compression, that work that they're going to do, they'll move that up probably around 20,000 BOE per day by the end of the year. So that's fantastic. Kicks off nice cash flow. That should probably be somewhere in that kind of $50-60 million range. They'll probably use part of that to maintain the field, and that really is the anchor for where the stock is right now. Where the upside is on this is they're actually doing a project in Kazakhstan where they have long-term gas supply. Gas is very cheap in Kazakhstan, and diesel is very expensive. And so what they're doing is they're actually building onshore LNG facilities. You don't really hear about that too much, but it's certainly a technology that's out there. They're going to have the first plant up and operating later this year. So I think it's by the third quarter. And what that'll allow is they're going to take this cheap natural gas, they're going to compress it, and all those fleets that have dual fuel use where they can use diesel or compressed natural gas. So think about buses, think about rock trucks for mining operations, things like that. They're going to sell that, and it's going to be greener, and it's also going to be cheaper for them. And this is where there's huge opportunity, because the payback on these plants is less than 2 years. And they'll now just, once they get the first one going, they'll just start to build these out and really finance them via cash flow. And so they just did a raise here recently, which was pretty nice pricing, and the stock's been down as a result of that, just as we chew through that offering. But I think that's where the opportunity really lies, is that Kazakhstan opportunity, and they're going to continue to do what they have been doing in Uzbekistan as well.
I'm going to put that same question to you I did earlier. What is it like operating in these countries? Is the operation supported?
I mean, it is. I mean, that's one of the reasons why the stock doesn't have a massive multiple on it, even with where they're at. I mean, it's a smaller company. It's 200-ish million in market cap, and it's in that region, which is those are both former Soviet Union countries, and so as a result, there's a lot of skepticism. But from what I understand, the facilities are in good shape. The government is in support, and that's actually one of the moats that they have with their LNG business is that the Kazakhstan government, they've spent years working on these contracts for gas, and they have them now. And it's not going to be something that somebody could come in and just and replace at any point in time.
Let's get to your next pick then, which is Aecon, ARE on the TSX. I think this is on infrastructure build out in Canada, if I'm correct.
It is, yeah. I mean, they're a massive construction company. They just reported last night, and I mean, the numbers were fantastic. The stock initially started trading down, and the last I looked, it was up on the day, as you know, they've really doubled their backlog to where their revenue is. They have over 10 billion in backlog, which continues to grow. And one of the things that they've really focused on over the last, say, 5 years is bringing down the number of fixed price contracts that they have, because those ones were a lot riskier and tended to be smaller margins, just because their projects take multiple years to build and costs can go up. And if they have a fixed price, then that's all they get from doing that. Now they have variable fixed or variable pricing contracts, and so that's meant that their cash flow is a lot more sustainable. Their earnings are a lot more sustainable. Their revenue is a lot more sustainable and predictable. And so this stock, we've really seen it growing from a revenue and earnings standpoint, but we've also seen the multiple come up. That's one of the criticisms of the company, and you do see that from some of the analysts. The fact that right now that multiple is significantly higher than where it's been over the last 10 years. But you have to factor into the equation that now they have much more predictability to their cash flow than they've ever had before. So we like it here. We continue to add it to the portfolio.
Let's get to your third pick, which is Groupe Dynamite, GRGD on the TSX, a Canadian company in retail that's reported done very well and has expanded now to the UK. I guess it's too early to tell how those operations are doing. They just recently expanded.
Yeah, I mean, that's fairly new for them. They're one of their focuses is still in the US. They have 300 stores, and I think roughly just under 200 of those are in Canada, and the rest are in the US, and now they're going into the UK. The interesting thing with them is that they've been very strong with their inventory turnover. So somebody like Aritzia turns their inventory over maybe 3 times a year, whereas Groupe Dynamite turns their inventory over 9 times per year. And then their margins have been really high as well. So their earnings, their EBITDA margin has been up in the sort of mid to 30s, whereas most retailers are in kind of that 20% range. Just recently, there was a secondary offering where the CEO sold part of his position. And I think that's been a bit of an overhang here in the stock. It was hitting new highs, and then when that happened and was announced, it's pulled back. So it's a bit of an opportunity here to get into the stock because of that overhang that's happened as he sold his position. Part of that was also bought by the company itself. And then they've also been really good with capital. They did a special dividend at the end of last year, which was something to help shareholders out. And it's been an amazing performer since the IPO just a few years ago. I
know they're at a lower price point. So are there any concerns about consumer spending moving forward for a company like this?
Yeah, I mean, the two things you have to worry about most are consumer spending and then trends. I mean, they've been very good at with their two brands attracting and being on the top of all the trends. But we've seen what's happened with other companies like, say, Lululemon, where competition's come in or they've missed the trend. It can be certainly harmful to these retailers. So they have to stay on top of that. And then consumer spending is always a challenge, and always something that you have to worry about for sure.
Yeah, especially when fuel prices are so high. Okay, we will leave it there. Bruce Campbell, as always, thanks for joining us. Appreciate your time, sir.
Yeah, thank you so much for having me on.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.